Short course on trade-based money laundering. Understanding and combating trade-based money laundering, concepts, case studies, and best practices. This is a free course from LearningTabs. By the end of this course, participants will understand the concept of trade-based money laundering, TBML, and its significance in financial crime. Be familiar with key trade and financial terms, mechanisms, and documents involved in TBML. Identify red flags, typologies, and methods used in TBML. Analyze real-world case studies to illustrate how TBML schemes operate. Learn effective strategies, controls, and regulatory frameworks for detecting and mitigating TBML. Chapter 1. Introduction to Trade-Based Money Laundering. What is trade-based money laundering? TBML refers to the process of disguising the proceeds of crime and moving illicit funds through trade transactions in an attempt to legitimize their origin. Trade-based money laundering involves using international trade transactions to disguise illicitly obtained funds and integrate them into the legitimate financial system. It is a method of laundering money by exploiting the complexities of international trade to obscure the origins of funds. Significance of TBML in global trade and financial crime. TBML is one of the most complex methods of money laundering due to the large volume of international trade, making it challenging for authorities and financial institutions to detect. Types of trade transactions and financial instruments. International trade basics. Export and import. Selling goods from one country to another. Balance of trade. The difference between a country's exports and imports. Trade finance. The financial instruments used to facilitate trade, for example, letters of credit, bills of exchange, documentary collections. Key trade terminologies. Letter of credit, LC, a financial instrument used in international trade, issued by a bank to guarantee payment to a seller if certain conditions are met. Bill of lading, BL, a document issued by a carrier to acknowledge receipt of cargo for shipment. Invoice, a commercial document issued by a seller to a buyer, specifying the product, quantity, and agreed price for the goods or services. Dual-use goods, items that have both commercial and military applications, often targeted in TBML schemes. Chapter 2. TBML techniques and red flags. Key techniques used in TBML. Over or under-invoicing, inflating or deflating the value of goods or services on invoices to move money between parties. For example, a company might invoice for more than the actual value of goods to transfer extra money to an accomplice. False documentation, using fake or altered trade documents, such as invoices, bills of lading, and shipping documents, to misrepresent the nature, quantity, or value of goods traded. Phantom shipments, creating fictitious shipments of goods that do not actually exist or are not actually shipped, with the intent to transfer funds without moving physical goods. Multiple invoicing, issuing multiple invoices for the same shipment of goods to extract additional funds. This can involve paying multiple invoices for the same goods to different accounts. Trade-based financing, using trade finance instruments, such as letters of credit, to facilitate the movement of illicit funds. This can involve arranging for financing that appears legitimate, but is used to disguise the true nature of the transaction. Shell companies, employing fictitious or front companies to facilitate TBML. These shell companies can act as intermediaries or buyers/sellers in trade transactions, creating a facade of legitimacy. Complex trade routes. Engaging in intricate trade routes and transactions involving multiple countries and intermediaries to obscure the trail of money and goods. Currency manipulation. Converting or exchanging currencies in ways that create discrepancies between trade invoices and actual transactions, allowing for the movement of illicit funds. TBML red flags for financial institutions and regulatory authorities. Trade red flags. Discrepancies between the description of goods in invoices and shipping documents. Unusual patterns of trade activity inconsistent with the business profile. Payments from or to entities in countries unrelated to the goods shipment or origin. Overly complex or opaque trade structures. Financial red flags. Inconsistent or inflated pricing. Payments in countries with no trade link. Multiple changes to letters of credit or invoice details without a clear rationale. Use of multiple financial institutions in jurisdictions with weak AML oversight. Chapter 3. TBML process flows and trade documents. The TBML process, a step-by-step flow. Step 1. Initiation of trade transaction. Involves an importer and exporter entering into a trade agreement. Here, a TBML scheme can begin with the agreement on false pricing, description, or quantities of goods. Step 2. Use of trade finance instruments. Documents such as letters of credit, bills of lading, and invoices are prepared. Fraudulent alterations or duplications can occur at this stage. Step 3. Movement of goods or phantom goods. Goods are shipped, often with documentation that misrepresents the true nature of the shipment. Phantom shipments, goods that never move, are another common strategy. Step 4. Settlement of payments. Funds move through financial institutions to settle the trade transaction. Money laundering occurs when funds are over or undervalued, siphoning off illicit proceeds. Step 5. Integration of funds. The laundered money is now cleaned and reintegrated into the financial system, often disguised as legitimate trade revenue. Key trade documents and their role in TBML. Letter of credit. LCs often used in TBML schemes due to the complexity and trust placed in LCs by financial institutions. Bill of lading, BL, critical in verifying the shipment of goods. In TBML, these documents may be forged or altered to mislead customs and financial institutions. Commercial invoices. Over or under invoicing is a major TBML tactic. Discrepancies between invoices and shipping documents should be considered red flags. Chapter 4. Case studies in trade-based money laundering. Case Study 1. The Black Market Peso Exchange. Overview. A TBML scheme used by Latin American drug cartels to launder proceeds in the U.S. through legitimate trade. Key tactics. Under-invoicing of goods shipped from the U.S. to Latin America, allowing launderers to pay less for the goods than they are worth and receiving the difference in illicit funds. Lessons learned. The importance of understanding the trade routes and discrepancies in pricing in order to detect TBML. Case Study 2. Russian Money Laundering Network, Magnitsky Case. Overview: a network that laundered billions through fake trades and shell companies, using fraudulent tax rebates in Russia. Key tactics: over-invoicing and fake trade transactions to move money across borders. Lessons learned: how the use of offshore companies and multiple jurisdictions complicated detection efforts. Case Study 3: Nigerian Oil Scam. Overview: using fraudulent invoices and shipping documents to siphon money from oil sales. Key tactics: falsifying shipment volumes and underreporting the value of oil exports to move funds illegally. Lessons learned: cross-checking trade documents and pricing benchmarks is critical in detecting discrepancies in commodity trading. Chapter 5: Regulatory Frameworks and Compliance Challenges. International Regulatory Landscape. FATF recommendations on TBML. Understanding FATF's approach to combating TBML and how member countries are required to implement these recommendations. Key regulations. Overview of U.S. regulations, OFAC, FinCEN, EU directives, and country-specific AML laws targeting TBML. Compliance challenges in detecting TBML. Complexity of international trade. TBML is hard to detect due to the sheer volume of trade, the number of parties involved, and varying global trade practices. Lack of transparency. The opacity of beneficial ownership structures and the use of shell companies pose a significant challenge. Evolving techniques. Criminals adapt to new regulations, continuously finding loopholes, making it necessary for compliance officers to stay updated on the latest trends. Chapter 6: Best Practices and Mitigation Strategies. Best practices for financial institutions on TBML. TBML can be challenging to detect due to the complexity and volume of international trade transactions. To combat trade-based money laundering, authorities and financial institutions implement measures such as Know Your Customer, KYC, and trade counterparties, understanding not only the client, but also the trade counterparties involved in each transaction. Enhanced due diligence, conducting thorough background checks and risk assessments on trading partners, especially in high-risk jurisdictions. Transaction monitoring, using advanced analytical tools to monitor trade transactions for anomalies or patterns indicative of TBML. Collaboration, cooperating with customs authorities, trade regulators, and other financial institutions to share information and coordinate efforts. Regulatory compliance, ensuring compliance with anti-money laundering regulations and reporting requirements related to trade transactions. Risk-based approach, RBA, to TBML. Applying RBA in trade finance, tailoring the level of scrutiny based on the inherent risk in a trade transaction. Screening for high-risk goods and jurisdictions. Some goods, for example, dual-use items and countries, those with weak AML controls, require higher scrutiny. Collaboration and information sharing. Public-private partnerships, PPPs, financial institutions, customs, regulators, and law enforcement working together to share intelligence on TBML activities. Use of industry databases, screening customers and transactions against global trade databases to detect anomalies in pricing and documentation. keep learning. At LearningTabs,